How to never get denied for a loan again.
You know what? It's a lot of things that we don't know as a community that we need to know.
Turn that penny into 5.3
A millionaire times
You want to learn how to make your money work hard for you rather than working hard for money. I want you to be there. Tune in. Hey, it's me again, and I am here with my girl. Insurance cash flow concept. It's a simple concept. It's a simple understanding, and all thy getting, get an understanding. That's why I'm here, to keep it simple. I want to make sure that we're getting the understanding. So I'm taking questions. I'm taking questions from the audience. I am determined to make sure this insurance cash flow concept not only help you become wealthy, but it's an opportunity for us to pass it on to our heirs, an opportunity to be able to explain it to our family. Now, one of the questions was asked, and I like that question, by the way, thank you. And I want to have the gentleman repeat the question while we were on break. It was a great question, and I think most of us are asking a lot of the same questions. So let's hear from the audience.
To reach 25K a year, how much do you actually have to have monthly to put in the policy?
Awesome. Great question. To reach $25,000 a year, you're looking at roughly about $2,100, give or take. If I have an opportunity to earn 6.125% on my money, assuming I bring home a paycheck of about $3,000 to $4,000 a month, and let's assume my bills are about $2,100. $2,100, I'm going to pay my bills. I'm never going to recapture that money. The money is gone forever. So I'm losing the interest that I could have made had I taken that money and put it over here. So if I put that money away in a policy, and then I took that money out of the policy and then paid my bills, the money is still there, earning interest as if I took it out. And so you're telling me my bills can get paid out of the same $25,000 that I'm saving and putting away? Are you getting this? Simple, right? It's simple, and it's that simple to be able to take your hard-earned money, now make your money work hard for you, taking your bill money and assuming that $25,000 is now saved. And at the end of the year, that $25,000 is now showing a return on your investment. In yourself. You're investing in yourself. You are your own bank. I think I have another question in the audience.
I noticed that you said it was tax-free. So you mean to tell me if I borrow the money from my policy, they don't charge me taxes for that? Or what do you mean by that?
Great question. Tax-free. Let's dig deep in that. I didn't really touch a lot on tax benefits because one of the things I wanted to keep stressing, you hear me talk about the 401k concept. And if I borrow money against that 401k, I'm going to be taxed because it's tax deferred. That means that at some point I'm still going to pay tax, even though I can look at a statement and say, wow, I have over $200,000 in my 401k. By the time I reach 70, if taxes are at 35 to 37%, now imagine what they will be probably by the time you turn 70. So let's assume taxes reach 50%. So $200,000 only gives you $100,000 by the time you turn 70, and it cannot be touched. That's one of the tax benefits. But great question on the other concept of tax free. When I take the money out, unlike a 401k, there are no taxes, because what is happening here, this is actually my cash accumulated value that is saved. This money is not a earnings. This money here is actually a dividend that is coming back in return because I am a part owner of an insurance organization, and every policy holder that has a living life dividend paying policy. And as we lend money out, other insurance owners and policy owners, and in return, the money that is made on a yearly annual basis goes back to every owner. Tax free. This is tax free accumulation, tax free. I hope that answers your question. Do we have any other questions?
I do have one more question about paying yourself back. It seems as though you're saying when I take out the money from my policy, and just like I would pay back my bank, basically put the money back into the policy?
Absolutely. I'm glad you brought that up. I designed the policy with you in mind in a way that is going to make sense for you. I don't know what your income is like. I don't know what you make on a weekly or a monthly basis. But what I do know is that we can design a policy where you can afford to put enough into the policy so at the end of the month, when your bills are due, or let's assume you get a nice lump sum, or you get an inheritance, or when you get your income tax return, this is an opportunity for you to dump as much in as possible, because the more you get in the first year, the more you can now take out the first year, the second year, the third year, and the fourth year. So if I only put enough that I can pay my monthly bills off on that particular month, by the time I get my next paycheck, I want to pay that loan back off. I want to recapture that interest. So once that loan is paid off, I can repeat the same cycle next month. I can now take that same money. It's still accumulating. It's still building. And I can pay my bills month after month after month. Within 4 years, not only are my bills taken care of, but I have over $106,000. 4 years. Say that with me. 4 years. Can you imagine the power of leverage and the magic that you now have when it comes to just a simple concept in 4 years? And if you can discipline yourself for 4 years, we endured the presidency for 4 years. So what's another 4 more years? 4 more years, I can now see a difference in what my money has always been designed to do. My money is designed to work hard for me. This is an opportunity for you to not only take advantage of the tax benefits, but to understand how you can pay yourself, pay your bills, and earn interest. Do we have another question?
I think what I like the most about the policy is that even if I can't pay it back out of my own money, like something comes up, it comes out of the death benefit, right?
Is that not amazing? I hope you heard that question. Not only if I decided I just can't pay the loan back for whatever reason because bills happen to come up or something happened to happen in my life and I wasn't able to pay the loan back, it's not required. You heard me say the house, there's no repo coming for the car. There's no foreclosure on the house. So what happens here is if I borrow $25,000, and let's assume I have a $100,000 policy, a $500,000 policy, and God forbid something happens to me 100 years from now, and that $25,000 was never paid back in year one, it's going to come out of the death benefit. Is that not amazing? So you're saying that I don't actually have to pay it back? Technically, you do not have to pay it back. Now, the benefit of paying yourself back, the process of paying yourself back is to accumulate more cash value. The rule of 72 says that if my money continues to sit and I never take it out, just like the penny concept, I never touched a penny. Now, on average, if I gave you this illustration again and I said, I tell you what, I'll give you $100,000 today in one hand and I'll give you a penny in another hand. And if you allow me to show you how I can double that penny over 30 days, would you take the $100,000 or will you take the penny? You decide. Now, before understanding the YLIP, you would have probably took the $100,000, right?
Yeah.
Absolutely. But if I shared a simple understanding of compounding, same concept here, compounding interest over a 30-day period. And if my money had the opportunity to double over 30 days and that same penny, absolutely, I will take that penny over 30 days any day of the week. That's $5.3 million. I don't even want to discount the 12 cents. We're talking an additional $68,709 on top of the 5.3, okay? Why would I now not understand or want to get an understanding when it comes to the value of my money? I value pennies now, and I want you to do the same. This is an opportunity for us to not just share it, but actually to live the wealth concept now. Not chase wealth, but actually enjoy wealth, actually have wealth, actually be able to enjoy the wealth benefit of the rich and the ultra rich. Now, I could say, some great cliches, it's your season, it's time to shine. And, you often hear me say, the better it gets, and good or good are our only options. Well, guess what? This is the good. This is the better. And this is the now. Everything is now. It starts now with your life insurance policy. It starts now for yourself, for your children, and your children's children. I have another question, and I'm so excited because I love questions. I know we want questions because that's how we get understanding. Yes.
I heard you say earlier, is it passed down to my family or out of that, I kind of heard you, but I'm trying to make sure I got an understanding so I can, something happen to me, I can pass it down to my...
Absolutely. Great question.
And then their kids also?
Absolutely. So one of the great benefits about passing it on to your heirs, assuming this particular policy was a $200,000 policy. Over time, this policy continues to grow because it is accumulating cash, which is an accelerated policy. So I started out year one with $200,000. By the time I saved up $25,000, that policy now is worth $225,000. By the time I reach here 4 years later, that policy is now worth $300,000. 10 years, 20 years from now, by the time you graduate and now you are called home and that policy may be at $800,000. And let's assume you borrowed $500,000 over the course of that policy lifetime. And now the policy face value is $800,000. I'll give you an example. We have $800,000. And with that $800,000, we are in a policy. And so I want to share that with you guys. So I'm going to use this marker here to give you an example of what I mean by that. So you heard me say the question was, how do I pass it on to my heirs? So I have a $200,000 policy that I started out with, but I have cash accumulation that has built over time. In 4 years, I have $100,000. That pushes my policy up to $300,000. If something was to happen, I used $100,000. My family will still get this amount here. I never have to pay it back. It will be deducted. This is transferred over to my loved ones and my heirs tax free. Okay. Now, if I'm teaching you the simple concept of never touching the money, then that means that I need to set up a trust for my family to never touch this money. I want this money to be transferred into another policy so they too can repeat the same cycle of borrowing against the money. Now, if they get this $200,000 after I'm long gone and just blow it, the penny concept is lost forever. So let's assume you live another 30 years and that policy is now worth $1 million. Okay? $1 million. This policy is worth $1 million. And let's assume you spent $500,000 of the $1 million. So minus, and you never got to pay it back. Why? You funded your lifestyle. What happens then? $500,000 is taken out of the $1 million, and $500,000 goes to your heirs. Okay? So with that being said, it goes to your heirs. This is the importance, and this is why it's so important to understand the magic of leveraging. Now, when I come back, we're going to talk more about explaining this to your family, getting the understanding, how you can leverage your money, and why it's time for you to get your life insurance policy. The simple cash flow concept. Thank you.
Wonderful. Oh, she did it. Oh, she did it. Live your blessed life.